So on the 23rd of September, the then UK Chancellor announced a mini budget of sweeping unfunded tax cuts. The markets reacted badly, the pound went down, and a lot of public attention was focused on mortgage rates that were spiraling up. But away from the public eye, there was a series of events that was unfolding that threatened to consume quite a number of pension funds in the UK. To help us make sense of what happened and whether we're out of the woods, we have first David Chambers, Professor David Chambers, who is the Invesco Professor of Finance and co-director of the Center for Endowment Asset Management here at CJBS. Welcome, David.
Hi, Conrad. Thanks for inviting me.
We also have Derek Steeden, Portfolio Manager at Invesco. Hi, Derek.
Hello, nice to be with you.
So, David, I think we agreed you will start off by giving us an overview about how the historical background and basically pensions investing 101.
That's right. Thank you, Conrad. Before I launch into that, let me just take the opportunity to say a few words about the relationship between my center, the Center for Endowment Asset Management here at the Business School, and more broadly, the relationship with the Business School and Invesco. Invesco have been a big supporter and continue to be a big supporter of the research and the other educational activities that we do here. And we're very grateful to that. Today, I've been able to draw upon the expertise that exists within Invesco. And Derek has very kindly agreed to talk about some of the more detailed issues surrounding LDI or liability driven investing and what occurred at the end of September and earlier this month. So let me just start by saying a few words about UK pension funds and give a bit of historical perspective. I'm going to assume no knowledge here. So when we talk about pension schemes, there are two broad types. If you're old enough and you're lucky enough, you'll be a member of a defined benefit scheme. And a defined benefit scheme is a good thing to have because the risk of providing the pension rests with the employer, not the employee, assuming the employer stays financially viable, because you will be guaranteed a pension upon retirement that will depend upon your number of years of service, of course, and there will usually be some inflation protection in there, and you'll be able to draw that pension until your death. And that will be the case irrespective of what happens to the underlying assets within reason. The other type of scheme is a defined contribution scheme. And there the risk is transferred from the employer or the sponsor of the scheme to the individual. And so then it's down to you how you invest the money as to how much you get at the end. And more recently, there are hybrid schemes which basically blend a combination of each. Now, we're largely going to talk today about the situation surrounding defined benefit schemes, despite the fact that these are not generally offered by employers these days, unless you work for the civil service. They remain very important in terms of their size and the number of assets. So if you flick up the liability profile, this just shows you for a defined benefit scheme, very simply, year by year from year 1 out to beyond year 30, the height of each bar will show you the value of the pension liabilities, the pensions to be paid in each year. Okay. Now they could be retirees, people already retired. They could be active members, people who are not yet retired, who are in the workforce, and deferred members are those who've reached retirement age but have not yet drawn a pension. But you can total all of these up, making certain assumptions, and therefore you can have a pretty good guess of what your liability profile is going to be over time. Now, there are some risks to these numbers. One is what we call longevity risk. So the fact that people live longer may mean that you are underestimating the amount of the pensions in years further out. There is also inflation risk, of course, because inflation may well go up more than the inflation protection that's in the scheme. And thirdly, there's also interest rate risk, because with any liability profile like this, if you want to calculate the present value of those liabilities to compare them to the value of your assets in the scheme to pay the liabilities, then the present value will be calculated by discounting the liabilities in each year at an appropriate discount rate, which is usually a high quality bond rate. So now historically, companies thought they could handle inflation risk in their pension funds by investing in equities. And they didn't worry too much about interest rate risk. And that was okay unless both interest rates and equities went down when the equities in the portfolio weren't going to give you any protection. Now, so for a long time, from around the 70s and the 80s, companies had more than 70 or 80% of their total assets in the pension fund invested in equities. Around the year, and that remained broadly the situation through to the end of the 1990s. Around the early 2000s, there was a change in legislation which forced companies in the UK to take their the assets and liabilities, and therefore the surplus or the deficit in the pension scheme, into the company accounts. There is an old joke about British Airways. British Airways was a company that had a big pension scheme, and it also had a big deficit. And for a long time, it was referred to as a company with a massive pension scheme and a little airline on the side. So companies were forced to start to address the risk in the pension scheme because now it was shown on the balance sheet of the company. One of the first big companies to address this was Boots. So in the early 2000s, as this table shows you, in March 2000, this shows you the assets of the Boots pension fund and how they were invested. So you'll see there was a chunk in UK equities and another chunk in non-UK equities, about 1.7 billion out of 2.3 billion of assets was invested in equities. So over 70%, 80% probably. Then you had the change in the legislation. You can fast forward 2 years later, and you can see from this how Boots switched out of equities completely into a bond portfolio. Okay, not UK gilts. So if you look at the far right-hand column, you'll see they held a lot of non-UK bonds. ILG stands for index-linked gilts, which were then being issued in size by the UK government, and also non-UK index-linked gilts. But now substantially, this was a bond portfolio. And the central idea is that you could buy bonds with different maturities, which would match the liability profile. And that would then reduce considerably your interest rate risk. And to the extent that you also bought index-linked bonds, that would also handle your inflation risk. So this was an approach that was followed more broadly, so that when we look at the evolution of asset allocation in UK pension funds, this chart is taken from the Purple Book, for those of you published by the Pension Protection Fund, for those of you who have some knowledge of this marketplace. This shows you, so the blue bar shows you the allocation to equities, largely public equities. The orange bar shows the allocation to bonds, and the grey bar is the rest. So you can see here the shift over the last 15 years away from equities into bonds, where bonds represents the majority of the portfolio. And that reflects the fact that companies wanted to de-risk their pension funds in the same way as Boots did. The other line on this chart shows you what's called the funding ratio. So where the line is below 100, that means the assets in the scheme are below the value of the liabilities. Okay. And so you can see for a considerable number of years over this 15-year period, actually aggregating across all schemes in aggregate, UK pension funds are in deficit. If you look at the funding ratio today, as of September 2022, that line has gone up even further. And now the funding ratio is up to around 130. So the pension fund industry is in a much healthier position. One of the major reasons that has happened is that, as we saw a moment ago, you calculate the value of pension liabilities by applying a discount rate. And we know that bond yields have gone up recently, in recent years, and that has driven up the discount rate and driven down the value of liabilities. So now, not all companies by any means have done what Boots did. And there are a couple of reasons for that. One is that there aren't necessarily the variety of bonds out there in the marketplace to fully match the profile of your liabilities with your assets. The other reason is that it does require you to be fully funded, i.e. you have assets that already match your liabilities, and or the company or the sponsor is willing to put more money into the scheme. Now, there are quite a number of funds out there that are in deficit, where the sponsor either cannot or is not willing to put more money into the pension scheme. And so they pursue a strategy which is called liability driven investing, where they try to do two things. Firstly, they use a portion of the scheme assets to try and address the interest rate risk or the liability matching issue, along with other risks. But the other thing that they do is use the rest of the scheme's assets to invest in equities and other risky assets, which they hope will drive returns more than a bond portfolio would do. So that's called the growth assets in the scheme. And the idea is that over time will help to eliminate the deficit. So I'm going to stop there because Derek is much more of an expert on the detail of liability driven investing, but I hope that gives you an idea of the background to this issue.
Wonderful, thanks David. I'll pick up from there if we just move on to the next slide. So by way of introduction, so I'm a portfolio manager in Invesco's investment solutions team. So we work with pension funds and insurers to build custom solutions. I was an LDI portfolio manager at Legal & General before this, and started my career as a trainee pensions actuary. So you can already see lots of overlaps with this topic. So as David has already introduced, we're going to work through a simplified example. I'm going to take about 10 minutes to connect how liability-driven investment strategies work through to what happened in the gilt market a few weeks ago. And then we'll take some questions and finish up thinking, well, what lessons could we learn going forward, or learn more broadly outside of this rather niche investment strategy. So I think it does touch on lots of broader, very relevant themes. So in this worked example, we've got a pension scheme which has promised pensions, which if you invested a pot of assets in government bonds today, you'd need to hold 100 million to fully meet those future liabilities. So that's the blue bar on the right. But as you can see, the scheme only has 90 million of assets, so they cannot afford to invest fully in that government bond portfolio. They need higher returns. So in this example, they've invested 70 million in growth assets. Let's say that's equities for simplicity. Now they could have allocated 60 million to government bonds, that would give you could give you a protection against 60% of the sensitivity of the liabilities to interest rates. But instead of investing 60 million in gilts, this scheme has invested 20 million in concentrated gilts, a bit like the concentrate you use to make orange squash. These concentrated portfolios give you more sensitivity to gilts than just buying them outright. You can look up on the internet how gilt repo agreements work, or interest rate swaps. I won't go into the detail here, but sufficient to say they give you concentrated exposure to government bonds, otherwise known as a form of leverage. Having that concentrated exposure therefore means that rather than only having 30 million left to invest in equities, 60 plus 30 is 90, you actually have a full 70 million left to invest in other assets. And that gives you a greater chance over the long term of earning sufficient returns to fully meet these liabilities. Now, as David mentioned, as interest rates rise, the price of a bond falls. And this is a known feature of this LDI strategy. A concentrated exposure to gilts will fall further. In this example, we started off with 60 million of gilts and, broadly speaking, 40 of borrowing, in the footnote at the bottom. Interest rates have risen, and we've now got 48 million of gilts, but we've still got our 40 million of borrowing. And so that means that the portfolio has fallen, the LDI portfolio has fallen from 20 all the way down to 8. It's now an 8 million valued fund, providing 48 million of exposure to gilts. That's 6 times as much as the value of the fund. We started off with 3 times as much, 60 over 20. Now we've got 6 times as much, 48 over 8. This is a problem. But notice at the bottom that the scheme overall is in a better financial position. It used to have assets sufficient to meet 90% of its liabilities, 90% funding level. Now it's got assets sufficient to meet 98% of its liabilities. So, and that's because whilst we've got this concentrated exposure to gilts, we still have less exposure to gilts than the liabilities. And so as interest rates have fallen, the liabilities have still fallen faster than the assets. So overall, the scheme is in better position, but we've got this high level of leverage in the LDI fund. So let's move to the next slide. That high level of leverage is then adjusted by rebalancing. So those leverage positions will require the banks with whom they've been transacted will require cash the next day or collateral to make to fully collateralize or make them whole on that change in mark to market. So the LDI portfolio therefore needs to pay that cash or transfer that collateral over to the bank. But then there are mechanisms in place to rebalance, to get cash from elsewhere, called that other portfolios in this example, to rebalance so that that 8 million fund becomes 15 million fund, and so on, to reduce that leverage. And that gives the fund more of a cushion, or restores the cushion in case interest rates were to rise further. That then leaves you with less money in your other portfolios, and so you have this sort of cascade effect where other assets then need to be rebalanced down the line. But you've got more time to do that because you had this mechanism in place for replenishing that collateral buffer quickly. If we move on to the next slide, most pension schemes are small or smaller. So whilst this liability-driven investing has become a very significantly used strategy, there's around 1.5 trillion exposure to the strategy across UK pension funds. That's compared to about 2 or 2.3 trillion of pension liabilities, as was. But most of that LDI is invested in these large segregated accounts that I was just describing, about 85%. But about 85% of pension schemes that use LDI use a pooled fund instead. And this is a way of a lot of investors gathering together, contributing a small amounts each, and the fund then providing this concentrated exposure to gilts. So same thing happens then. Interest rates rise, counterparty bank calls for collateral for the LDI fund. The LDI fund is a fund. It doesn't have access. It's not part of the pension scheme. It's a fund employed by the pension scheme. And so the fund has a mechanism, a recapitalisation mechanism, whereby they write to all of the unit holders asking them for more cash. Normally they have 10 days to provide it. The pension scheme then provides that cash, but it's sourcing it from other funds itself. Now, if we look at what happened, we move on, what happened in the end of September, interest rates started rising very quickly. You can see on the 22nd, the Bank of England, there's a blip as this index-linked gilt yield rises, where the Bank of England raises interest rates by less than expected. They only do 50 basis points, not 75. And so gilt yields feel that's not enough, and they rise as a result for reasons we'll won't have time to go into now. The next day, the government announces its now so-called mini budget, and you can see a wobble in the morning where these gilt yields rise another 40 basis points. Now, these LDI funds have a resilience of around 100 basis points. That is, they can cope with interest rates rising by 100 basis points, still have plenty of collateral to manage. Leverage is not excessive if interest rates rise by 100. And that has been sufficient to withstand the volatility of interest rates for the last decades. But here you can see that the market starts to catch a cold. There's when we come in, so that's Thursday and Friday. When we come in on Monday morning, yields open much higher. And so over a period of 2 days, we've blown through that 100 basis points of buffer. The real yields are almost 100 basis points higher than they were at the start 2 working days ago. And so these pooled funds then have to issue their notice out to their investors to provide more cash. But as yields then continue to rise during the day, actually it becomes clear that 10 days is going to be too long. There are provisions in a lot of these funds to call for cash with shorter notice. And so when we come to the 27th, it becomes clear that cash is needed really that day. And so requests get made to provide cash the same day. But of course, these 2,500 pension funds or whatever, on the whole, cannot provide cash the same day. They're not set up for that. They can provide it in T+10, they can probably provide it a bit quicker, but not the same day. And so these funds have a mechanism that in extremis, they can cut exposure, they can reduce the size of their derivatives, and that reduces their exposure to larger collateral calls from the banks to keep those funds solvent, stop the net asset value going all the way to zero. And that starts to happen on the 27th. Gilts start being sold. What happens when you have more sellers and no more buyers is that price goes down and the yields go up, and that creates something of a doom loop, whereby that then brings in these much larger schemes who have more flexibility, as I was saying earlier, to rebalance, but even that flexibility starts being strained. And so there's a real risk that these whoppers are going to have to start to sell exposure as well. So when we come in on Wednesday morning, the 28th, you really see yields starting to race away. Then the Bank of England at 10 a.m. come in and say, we will buy gilts as the sort of backstop. Will operate a reserve pricing policy to be available if you need to sell. And that calms the markets considerably. Yields drop back really very rapidly on that Wednesday, as you can see. So I think we are just about done. Let me go ahead on to the next slide. You can see I've just graphically shown the problem that we've got. The banks have called for cash. There's no time to source it from the pension fund, so they've had to close positions. So back to the previous slide. We are now in a position with, now the dust has settled, a greater resilience. So whilst these funds stress tests had determined that, broadly speaking, 100 basis points was sufficient cushion against having collateral to meet 100 basis point rise in interest rates was expected to be sufficient, 99.5% scenarios and so on. Actually, it becomes clear that a larger buffer is needed. So that's why significant cash was called from these LDI funds, and significant cash was also needed from those large segregated accounts to recapitalize, giving those accounts lower levels of leverage and therefore a resilience against higher rises in interest rates. And at the same time, we have additional facilities that the Bank of England has put in place and remain there. We have a new permanent short-term repo facility which offers the ability for the banks to source cash at short notice by pledging a range of collateral, which then they can then offer the same or similar terms onto the pension funds, and also a long-term repo facility. So the market is now more resilient against this particular stress, lower levels of leverage in the system. But it does mean that pension funds asset allocation is now very unbalanced. So a lot of schemes have had to sell what could be sold, selling more liquid assets, even if they were contributing to the return generating objectives of equities, or contributing to the interest rate hedging. So corporate bonds provide high yields and sensitivity to interest rates. So those liquid assets have been rather hollowed out. We expect around 400 billion of cash has been sucked out of other assets year to date, and over half of that being in the last few weeks. Give you a sense of scale, 400 billion is larger than the sum total of all of the sterling denominated investment grade corporate bonds. UK credit is a smaller market than this round of cash. So that's a lot of rebalancing that's happened. And so we should expect to see this ripple effect as other less liquid assets are sold to rebalance the liquid assets, restore asset allocations to where they need to be. But bear in mind the underlying dynamic that interest rates are still higher than they were at the start of the year, a lot higher. And so I guess returning to where we started, funding levels are much higher, and therefore there is less need for those higher high risk, high return targeting assets. And so this rebalancing is not will still have left most schemes in a better position than before, albeit having lost a few pounds due to stress over the last few weeks as they've had to deal with this large and urgent collateral calls. So with that, I'll pause. I think I'm handing back for any questions or any other comments that David wanted to make.
Yeah, I mean, let me start by probably Conrad has got some questions from the audience, but just listening to you, Derek, one thing that did occur to me, you were talking about the fact that schemes now have to think about a bigger than 100 basis point intraday move in bond yields. And in order to protect for that eventuality, they're having to deleverage. So something's got to give, right? Either they've got to, if they're deleveraging, they're going to have to put more money in, other things being equal, to fund the asset position, or I suppose accept a lower funding ratio.
Well, yeah, this is why this 400 billion, it's all estimates, facts and figures hard to come by, but that's why those assets have been disinvested from other assets and put into the LDI accounts. But with higher funding levels, those growth assets the schemes don't, on the average, don't need so much of them. So that rebalancing it was always expected that as interest rates rise, funding levels go up, and this asset allocation will further accelerating this exit from equities.
So even though they've been forced to accept a lower allocation to growth assets, that's okay now, because their starting position today is that the funding funding levels are much higher, so they don't need as big an allocation to growth assets as they did previously. That's
right, and we're talking about the industry as a whole. There'll obviously be special cases.
Yeah, obviously yeah. I mean, schemes that are heavily in deficit are going to struggle much more.
Yeah, it's likely that their deficit will be smaller.
But they're still.
Yeah, exactly. Yeah, it's also true that some schemes have asked their sponsoring company for an advance contribution of cash. That's one way of meeting these cash calls. So we've seen pre-existing commitments brought forward. There's a whole range of solutions and options that different schemes have employed. But yeah, lower levels of leverage are needed now, and lower levels of leverage are affordable, given we're still in a more volatile interest rate position. The markets seem to have taken comfort of the new government's more fiscal probity, but we await the budget next month. So we're still in a more volatile world.
So let me just ask one other question. So one aspect of this that we've been discussing is obviously the interest rate risk or the intraday movements in yields. The other relates to the operational aspects that you were referring to. And perhaps you just spell out, so this, particularly in the pooled fund where you have this mismatch of settlement between the T+1 for the counterparty banks and T+10 for the pension schemes, are you saying that's being handled by things such as this short-term repo facility and the like?
So for a pool fund, there's a variety of approaches, but this need for recapitalisation hasn't come by surprise. So many managers of LDI funds have in place agreements with their clients as to where they can source cash themselves. So sometimes an LDI manager will also manage a cash fund, a short-dated credit fund, or whatever, and they'll have written in those guidelines that money can be called. But the point is that even where that was the case, often those levels were blown through quite quickly, and we still had to go back to the scheme for more. This repo facility I was talking about is a facility available from investment banks from the Bank of England, but that allows them to offer liquidity downwards to their clients, right, whether that's an LDI fund or whether that's a segregated LDI account. Yeah.
Cool. We have some comments from the audience, really. I think we've got Andrew from London who thinks that cash is now, at least individually, very attractive. I don't know where he gets the 5% interest rate. I'd be interested to find that out.
I guess he's suggesting that's what you earn on cash, compared to only a few months ago where you weren't getting very much at all.
Yeah, and Tomoki from Japan, he's also very heavily into cash, 80% in cash, which is quite high. But I guess the question here is, because of this incident, have we seen, especially the DB funds, being very much more risk averse now, or actually, did the system of LDI, did it work really? It's just that it couldn't have, no one could have foreseen something so dramatic as that huge intraday rise.
Thank you. Well, I think it's worth exploring briefly what would have happened without the use of LDI. So over the much of the last decade, interest rates have been falling, and that means the cost of purchasing this low-risk matching portfolio has been going up and up and up. And so without this exposure to gilts on the asset side, higher and higher contributions would have been required from sponsoring companies. We would have seen more companies declaring insolvency because they couldn't afford to keep their pension promises. Yeah, worth bearing that in mind. What we've had is really a liquidity risk as a result of operational risk. So money at the scheme level, as we shared, was there. It just couldn't get to the right place quickly enough. So that's, I think, one lesson that we can learn about, I guess, complexity. Rather than way beyond LDI, we make much use in the financial system of stress tests. How large a rise in interest rates could we cope with without getting into trouble? And we think, well, the likelihood of that is small enough that we feel that's a prudent level. Rather, I think this has shown the need for what has been called reverse stress tests. So what events would break this, and what would we do if they happened? Rather than trying to put a percentage on likelihood on it, consider what you would do in that scenario. And that's where having these collateral waterfalls, as they're called, become very important. And the question is, what happens further and further down your waterfall? And then looking at the details of that. So, for example, equities are a liquid asset that can be sold very quickly. But if it's a pension scheme, you've invested in a fund with weekly liquidity, that's not very helpful. It still may take you a week plus 2 or 3 days settlement to get your cash out, even though the equities themselves are very liquid. Just those kinds of details that are we overlook at our peril, I think.
Let me just. I think broadly speaking, LDI has worked. It has been exposed by what was a 7 standard deviation event, and as Derek said, if you get these tail events, they can sometimes expose problems. But overall, I mean, we shouldn't be throwing the baby out with the bathwater. They can't eliminate all risks, and so the boots approach is the lowest risk but you have to accept for various reasons that is not possible, or you wouldn't want to do that these days.
Yeah.
But LDI as a solution, broadly speaking, works, I think, notwithstanding what's happened in the last few weeks.
Yeah, I think it raises this interesting point that of complexity and the unintended consequences sometimes of complexity, where you've got multiple handoffs between all the different stakeholders in a pension fund, and sometimes we've got fiduciary managers, managers of asset managers in there as well, or various teams. The more handoffs you have, the more likely there is of a delay, or the harder it is to act quickly. And so whilst I guess all of us will be involved in solutions either in our own lives or in the lives of others or in our professional work, there's a question that we've had of how it comes back to that principle of Occam's razor. What is the simplest solution that will do the trick? And is the additional complexity worth it for the additional benefits? Often it will be, but it's worth asking the question. Sometimes it's worth going for a solution which is slightly suboptimal in order to manage these other second, third order risks. And certainly handoffs between stakeholders and authorizations and so on adds time. And in this case of rebalancing, that was time that the industry didn't have.
Would you allow me just a very brief comment,
Sure.
Conrad, on the points that were raised about cash?
Yeah, go ahead.
And I apologise to the two people in the audience if I've misunderstood the intention of their comments, but cash is not a long-term, as an asset, is not a long-term solution to the problem of pension funds. I mean, the only instance in which you would want to go to cash, I think, is, as was indicated, is if you're highly uncertain about the direction of markets. But we know, I mean, both as academics and practitioners, that trying to time markets, trying to get in at get out at the top and get in at the bottom is extremely difficult. And anytime you're holding cash for a prolonged period of time, there is an opportunity cost in terms of the returns that you forego. So these relate to issues. This relates to the issue of asset allocation in general, as opposed to specifically the problems of pension schemes.
Well, I realised we asked at the start, how are you saving for your retirement? I wonder if this maybe answers to.
Yeah, I think that was how the people are thinking about it. Yeah. But
so maybe there'll be times when you're depends on your time horizon, doesn't it? If you feel that the markets are very uncertain and you've got a lot of cash to invest, the approach of taking your time and not being beholden to the prices on one day is important. So there can be a time for holding cash on your personal side, but David's points are very well made, that over the long term, you are going to have a high likelihood of having a poorer retirement if you leave it in cash forever, and therefore there comes a time you have to think what level is appropriate. And as David said, very hard to time markets. Averaging in over a period of time can certainly reduce your exposure to poor entry levels. And then on the other side, probably averaging out at the other end. De-risking as you get older, as you start taking a retirement income, can be important to avoid exposure to prices on one day. And that's exactly where LDI comes in. It's about matching your sensitivity, about building up that matching portfolio, which then pays out cash when it's needed to pay pensions, or in an individual's case, delivers you cash when you need it to spend.
Yeah, I have lost many fingers trying to time the markets, catching falling knives and whatever kind of metaphors. But on that note, following David, your warning about not timing the market, Sachin asked, what do you feel about interest rates? When do you think interest rates are going to peak?
Oh, good, great question.
Blimey, Sachin, if I knew the answer to that, I wouldn't be sat here, as they say.
I think it's worth saying.
I'll let Derek go.
Don't worry. I'm not going to tell you. I'm not going to tell you a date. I'm sorry, but the point to remember is that there's two things. There is the central bank base rates. When is the central bank going to reach its maximum interest rate? And what happens after that? And you can look at markets. If you have access to Bloomberg or other systems, you can see what the market as a whole is pricing, what its expectations are for when those rates peak. Current expectation is that we have some more hikes to come. We're expecting sort of 75 basis points in their next decision on the 3rd of November. It might be 50, it might be 100, and so on, and some more hikes after that. We're expecting those hikes to peak sometime in the early to middle of next year. But it really depends how persistent inflation turns out to be as to whether those hikes need to be more or less, and whether to be quicker or slower. Now, the separate but related issue is one of bond yields. So a 10-year bond yield, for example, is the price investors are willing to pay now for exposure to interest rates over that 10-year period. And so those reflect not just the expectation of central bank base rates over that time, but also the supply and demand for those bonds. And so in late September, early October, you saw a massive rise in gilt yields, which is another way of saying massive rise in the 10-year interest rate. That wasn't all due to expectations for bank base rates. It was due to the massive supply of gilts. And so one thing to look at as you're looking at bond yields is to bear in mind how much of that is due to a risk premium for supply and demand, and a risk premium for credit risk when we're talking about corporate bonds. And in that sense, you may see individual companies having interest rates that or bond yields that carry on rising if their financial strength weakens, even if underlying central banks rates don't rise. I believe that we're still in a long-term environment in the West of an aging population, indebted governments, corporates, and individuals, and therefore the burden of higher interest rates is much higher on society than it was when debt levels were lower and when the working age population was larger. So there are still long-term trends towards lower interest rates, but that's very much a long-term theme. In the short term, there's a lot of uncertainty geopolitically. Energy tends to drive everything else, and so it will take some years for the energy markets to rebalance themselves. And potentially, there are clearly geopolitical risks that could have a very dominant impact in the short term. But if you think very long term, as an actuary, I try and think, ultimately we expect over the very long term the natural rate of interest ought to be lower, and that's why real yields in government bond yields net of inflation have been over the long term declining, and that trend is still there underlying the shorter term dynamics.
Sorry, Derek. Let me just add a couple of quick points. Sachin, it was a good question. So let me treat it seriously for a moment. I'd add two things. One is in the medium term, of course, central banks around the world, including in the UK, are going to be turn sellers of the government and corporate bonds that they have bought after the 2008 financial crisis. So, they're turning from buyers to sellers, and that's going to add to supply. So that is going to be a considerable headwind for interest rates subsequently falling, I think. And the other thing I'd add, which relates to a piece of research that a colleague of mine, Elroy Dimson, and others have done, is that when interest rates are rising, it makes it also provides a considerable headwind for growth assets, principally equities. They tend not to do anywhere near as well as they would when interest rates are falling. So this does have implications for the rest of the portfolio as well, the longer it lasts.
So thank you very much, David and Derek, for that. Before we wrap up, David, do you want to say a few words about the work that the Centre does, if for those who are interested, who found this talk really interesting?
Yes, we, in addition to working away in our ivory towers, doing interesting bits of research, we are very engaged with the practitioner community at the same time. And so we've held a number of events over the years from conferences to workshops. So if you're interested in that, please get in touch. There will also, these events will be advertised on our website, but if you want to get on a mailing list, please let us know, and we will we can give you advanced warning. I should also mention that Invesco is a supporter of other research centres at the school, in particular the Centre for Alternative Finance, which is our sister centre, and they also organise a large number of events, and they have a similar site that's hosted on the school website.
Thank you so much. And thank you to the audience for watching. Thanks, David. Thanks, Derek, for giving us your time. The next episode will be in 2 weeks' time, the 11th of November, same 12:45 to 1:30 UK time, where another faculty from CJBS, Professor Alan Jack Linzer, will talk about why he, as an accounting professor, has made it a mission to study disinformation and the kind of impact it has on businesses and societies. So please join us then, and till then, please stay safe and be well.